Jim gave a little overview, but I'm Billy Grenis, and I work at the Stellar Development Foundation. We are a nonprofit that supports the Stellar blockchain, which the end of this presentation will be all about. But just high level, the Stellar blockchain is a payments blockchain, and we want to make sending payments as easy as sending email. A little bit of background. So I know that you're all kind of thinking about your careers and what you want to do, and you're in this awesome group. So I went to University of Michigan. I actually did spend one summer here. I was working at a steel company. I was a material science engineer undergrad, and I worked in Northwest Indiana. So I lived on UChicago campus for that summer, and then I graduated and ended up going into consulting at PwC, where I studied emerging technologies and helped clients implement the latest and the greatest. And that's kind of where I fell in love with blockchain. I found it was kind of this one technology that was hard to explain. I was there for a while and then ultimately went to business school. And after graduating from business school, I said, I need to get in this space. And so I went all in, and here I am presenting on behalf of the Stellar Development Foundation, and excited to give you an overview of blockchain. Anyways, enough intro. Let's just go quickly through the agenda. We're going to start with an intro to blockchain, very high level, but then we're actually going to kind of peel the onion back or go a little deeper and talk about Bitcoin, where blockchain all started. Then we're going to go into the evolution of blockchain, so the other protocols that have since come out of that. And then, of course, I'm here on behalf of the Stellar Development Foundation, so I have to talk about Stellar. As I said, there'll be a couple opportunities throughout to ask questions, and then definitely at the end. I hope there's time. All right, so let's begin. So advancements in technology have made information movement easy. If you think of the internet, right? Emails, TikTok, Instagram. In a split second, I can send a text message from here to Japan. But the same has not always been true for money, right? If you think about it, if I have a physical $5 bill, I can hand that $5 bill to you. And you know that I can't go to somebody else and hand them that $5 bill. But what if you want to do that over the internet? What if I want to give you $5? How do you know that I won't just spend that money with you? Everything on the internet's replicable. I can just spend that money at $5 somewhere else. And so really, there is no way to do it. Well, actually there is, and that's what banks, financial institutions do. And they built a whole system around kind of serving in the middle and helping us move value across the world. So what does this mean? So this means that these centralized companies, the banks, the fintechs, or now even tech companies, they have your information, they control your data, and of course, worst case, your money is prone to bad actors. Even worse, the financial system is disconnected. So it's made up of tons of entities that all have their own systems and technology. And the problem becomes even worse when you talk about cross-border payments. So raise your hand if you've ever sent money overseas and had to deal with sending money across the border. Right? It can be slow, it can be costly, right? And oftentimes the money that is being sent overseas is for the people who need it most, right? People sending remittances back home, and they're affected by those highest fees. And of course, even worse, there's governments and centralized banks and institutions that have been corrupt. And you see it time and time again with governments like Zimbabwe. Their inflation was in the trillions of percent. And even today, Argentina and Venezuela have 30, 50% inflation, which means your cash value this year is worth 50% less next year. You have $100, next year it's worth 50. So introducing blockchain. In 2009, the idea was to connect the world with a bunch of entities known as nodes that anyone could join and leave the network and create this place where you could move money freely without an intermediary. And so you may have heard of this first blockchain. It was proposed by Satoshi Nakamoto in 2009, and it was called Bitcoin. And Bitcoin is no different than the traditional ledger that you're used to looking at. So this here is a time-stamped ledger of transactions, which has been around for centuries. Bitcoin does the same thing, except this time Bitcoin enables you to move money around without a central entity managing this ledger. So now you're looking at a bunch of nodes around the globe that are all communicating, but how do they agree on transactions and what's next? And this is where what's called a consensus mechanism comes in, where all of these nodes in the network follow a certain software that allows them to agree on what transactions should be added to the ledger. So instead of trusting one entity, now you're trusting a bunch of entities that are all agreeing on transactions. And of course, all of these nodes communicate, and because they're all communicating, you can't have one actor who's going to change the financial records, reverse a transaction, change an amount. So in essence, blockchain is a public timestamp series of immutable records of data that are synchronized across multiple independent stakeholders. Now, this is a very high-level overview, and if you're like me a few years ago, you're probably like, okay, great, I still don't get it. So let's start with where it all started, Bitcoin. So when I was at PwC, I told you I became fascinated with blockchain technology. And I found that there was really two sides. There was the kind of overly simplified version, which is blockchain or Bitcoin is a decentralized ledger that does X, Y, or Z. And I was like, what? Like, what does that actually mean? Or the other side is there was the very technical programmers, the people that were actually building Bitcoin and other blockchains. And so I said, I need to fill this gap in the middle. And so that's why I created this Billy Bitcoin, which is a technical explanation of Bitcoin that anyone can understand. So you are the perfect audience to understand. And all of these slides for this section have come from the website that I built, which you guys can all check out after this if you're interested in reading on. So before I go into Bitcoin and how it works, we need to talk about a very important concept. And that concept is hashing. So if you look at this Harry Potter, that's a book. And in the hashing method of ISBN, you're able to turn a book into a string of numbers. So hashing is turning something into a recognizable, easy to understand format. Another example of hashing is zip codes, which were designed to help money zip through the country. And you turn a city and a state into a string of formatted numbers. So can anyone here try to explain what the value of hashing might be? Like, why do we convert books into ISBNs? Why do we convert city and states into zip codes? Any bold volunteers? Yep, over here. Yes, exactly. So if you think about Harry Potter and the Sorcerer's Stone, how many versions are there, right? What different languages has it been translated into? What different releases, right? What about other Harry Potters? So if you're using kind of the English language, it could be easy to confuse a different version of a book. But if you're just going by a string of numbers, that's right, it's easy to identify. And that's exactly right. I mean, in the end, hashes are all about data integrity, right? And even think about a mail delivery person, can't really read your handwriting, but they can see the zip code numbers or even automatically process it. Numbers are easy to read. So, and why are we talking about hash functions? Well, Bitcoin uses a special type of hash function known as a cryptographic hash function. And so that's kind of a scary word, so I'm going to give you a simple example to teach you about cryptographic hash functions, and that is through Scrabble. So here we have a Scrabble board, and you've just played the word cactus. Now, you've all probably played Scrabble, right? How do you figure out what a word is worth? Well, you simply add up all of the tiles. So in the case of Scrabble, as a cryptographic hash function, you can determine the hash of any word simply by adding up all of the tiles. In this case, cactus adds up to 10. So here it is again, cactus. So this is property 1. When I told you to add up cactus and figure out what it was worth, it was easy, right? Property 1 states that it's easy to calculate a particular hash, and that data will always have that same hash. So with cactus, no matter which letters you add first, no matter what order, you're always going to get to 10. Now, what if instead of asking you to add up cactus, I said, I'm thinking of a word, it's worth 10 points. What am I thinking of? Could anyone get that? Right. In fact, it's impossible. And you could guess cactus, but there's no way to know for sure what word I'm thinking of. There's many different words that are worth 10 points. And so that's property 2. It's impossible to take a hash and figure out what the original data was. Now, property 3 is an interesting one because Scrabble, at least the way I was showing it, doesn't totally work. But luckily, we have our Scrabble board here as well. So property 3 states that it's very, very unlikely that any two different pieces of data will have the same hash. And so, of course, many words in Scrabble can have the hash value of 10. But now if we have a super complex Scrabble board where each square on the board has a different function, and you place any word on different squares, you're very unlikely to have the end result be the same score or the same hash. So when we think about hashing algorithms when we talk about cryptographic hashes, we're not usually talking about board games, but rather a computer algorithm that can actually convert one set of data into a standardized format. So with Bitcoin, we're talking about SHA-256, which instructs a computer to turn any piece of data of any length into a standardized format of 256 ones and zeros. So you see my name, Billy, on the board, and you see the hash below it, right? That's a string of ones and zeros. And just like Scrabble, my name, no matter where you write it, when you hash it, will always hash to this exact set of ones and zeros. But if I covered my name and handed you this hash, and you could take it to your computer, you could do whatever you want, there would be no way to know that that hash represents Billy, unless I told you, unless you saw it. So you can't go backwards. And it's important to note also below I'm showing the hexadecimal. So as humans, reading ones and zeros is very hard, even though that's what computers prefer. So we actually write in hexadecimal, and if any of you have seen a Bitcoin public key or private key, the hexadecimal version will probably be more familiar to you. And also, property 3 stated that any two hash inputs are very unlikely to have, any input is very unlikely to have the same hash output. And that's the same here with SHA-256. There is an infinite number of things that you can put into SHA-256 because at the end of the day, it just can run on any piece of data. And there's virtually infinite number of outputs. Does anyone here know how many possible hashes there are with SHA-256? Remember that in each slot, it can either be a 1 or a 0. See in the very back. That's right, 2 to the 256. And how big is that? Big. Very good, I'm impressed. In fact, it's so big that it's 5 billion times bigger than the number of atoms in our galaxy, and many magnitudes bigger than the number of grains of sand or gallons of water on Earth. Like, just think about that. That is big. So there's one more property I want to talk about with cryptographic hash functions, and that's even small changes to the input data result in dramatic changes to the output. Now, I showed you my name as I'm kind of spelling it each way, and if you look between the B and Billy, there's no similarities. There's no pattern. There's no way to figure out what it was. If you have BI, the hash, you can't figure out the hash for Billy. And we'll talk about why that's important later as well. So now you're saying, okay, this guy came to talk about blockchain or Bitcoin, and we're getting a kind of cryptography hashing lesson, but what does this have to do with Bitcoin? So raise your hand if you've heard the term miner in reference to Bitcoin. Not oil mining, but cool, most of you. And so what a miner is a node on the Bitcoin network that is organizing transactions and validating them. So when you hear the term miner, now you know the miner is actually grabbing transactions from the Bitcoin network that people are putting out and organizing them into blocks. So the miner is putting together this block that you see. And remember, this is just data on the computer, so this is ones and zeros. So you can put a block through the hashing algorithm we just learned about, SHA-256, and you get a resulting hash. So what do you do with that hash? Well, you take that hash, and then you use it in the next block. So essentially, these two blocks are now linked. And finally, once you do that with a number of blocks, you have a chain of blocks, or a blockchain. So essentially, a blockchain is a number of blocks of transactions, and each block contains the hash of the block before it. So remember property 4 state that even a small change to a piece of data will have a complete drastic change of the resulting hash output. So what will happen if I go back to block L, the first block, the blue block, and try to change transaction data? Like there? Yeah, it would be invalidated because you would see that all of the hashes upstream would no longer be the same because you change one piece of data, it affects everything going forward. That's exactly right. So here it is, miners putting together blocks of transactions. But who decides which miner gets to create the next block? So there's one extra piece of information I needed to tell you, and that's the hashes that are going into these blocks, they actually have to start with a certain number of zeros. And you'll see why in just a bit. So in block M that's here, or sorry, in block N, as in Nicholas, block M, the hash of block M is listed in there, and you'll see it has 4 zeros in hexadecimal, which actually means 16 zeros in binary, ones and zeros. And it has 4 zeros. So in this simulation I'm showing you, for a miner to be successful and to get their block approved, they need to find a hash output of 4 hexadecimal zeros, which is equal to 16 zeros in binary. But how do you do that? So there's one more piece of data that goes into each block, and it's called a nonce. And what mining is actually iterating this nonce over and over until you find a hash that outputs, that has the number of zeros you're looking for. So once again, 4 or 16 in this case. But we learned that there's no way to predict what a hash output will look like. So it's not like your computer can narrow it down to certain nonces that may work and just try those. A computer actually has to go through every number it can and iterate and brute force this nonce number and try new numbers until finally they find the winning block, the right hash. So in this case, 59518 was the right nonce. That gave them a winning block of 4 zeros, 16 zeros. Now, this one won, but there's probably many, many other nonces. There is many, many other nonces that would have worked, but this miner was the first one to find a nonce that did work. So mining is a little bit of a weird concept, so I want to relate it to coin flipping, something that you're all quite familiar with. So if you imagine that, and remember, this is now a hash from SHA-256. It's 256 ones and zeros, which is every 4 zeros represents 1 0 here in hexadecimal. So if we think about every 0 as a head and every 1 as a tails, what percent of hashes will start with 1 0? 50%, right? There's 2 slots, and each one can either be a 0 or a 1. So what about 2 heads? Well, that's 25% chance. And for every head you want to add in, you're lowering the probability. It's the same as you flipping that many heads in a row. Now, you could probably spend an hour or even less right now and flip 4 heads in a row, maybe 5, 6, 7, just manually flipping quarters. But you certainly could not do 32 heads in a row. And that's what the first Bitcoin block required. It required 32 heads in a row. So this hash here would actually have 32 zeros to begin it. And you can see that the average number of flips you would need to make is 8.6 times 10 to the 9th. And back then, in 2009, when Bitcoin was created, your personal computer has enough computing power to go through this iterations enough time to eventually flip 32 heads in a row or find a hash with 32 zeros. Now, fast forward to 2021 this morning. I looked at the latest Bitcoin block. The latest Bitcoin block's hash had 80 heads, or 80 zeros. Now, obviously, that's magnitudes higher than when Bitcoin started. And why is that? Well, as more computing power entered the network, you had a bunch of computing power going in, and you'd solve this faster. So if you think about you and someone else flipping quarters, the combined version of you two flipping quarters is more likely to find 4 heads in a row than if just one of you was. So adding computing power to the network is no different. If you add more computing power to the network, more miners mining, you're going to find an answer quicker, or find the appropriate number of zeros faster. And so Bitcoin wants every block to be found in 10 minutes. That's programmed in. And so the difficulty, or the amount of zeros that are needed to solve the winning block, adjusts based on the average computing power of the past month or a certain number of blocks. So as more mining power goes into the network, more zeros are required at the beginning, and it requires more computing power to solve. And why would anyone mine Bitcoin and kind of validate for the network transactions? Comes down to incentives, right? The winning block right now receives a certain number of Bitcoin that are minted and created, as well as there's a transaction fee on every transaction that individuals make, and the miner that wins the block collects all of the Bitcoin that comes from transaction fees and that reward. So that's it. Now you understand Bitcoin and blockchain. Congratulations. So in 2009, through this picture up there, you could pretty much use your personal computer to mine Bitcoin. In fact, there probably weren't many people on the Bitcoin network putting energy in, and it required, remember, 32 coin flips or 32 leading zeros. So the way I like to think of it back then is if anyone can really come and go and join the network and serve as a validator, you really could have perfect competition. But now in 2021, we've come to this world where mining is way more concentrated into, let's say, an oligopoly of large players who have enough money to have this massive infrastructure committing energy to mining Bitcoin. And that is a discussion of like how decentralized it is, but also the bigger discussion is in energy use. So these are article headlines, but Bitcoin consumes more energy than Argentina. It is scary. But you know, when you think about everything we do in life, whether it's driving a car, flying a plane, like everything uses energy. So the question is, what are we using energy on? And I think that a lot of the debate stems of like, yes, of course it's bad to just use energy, but maybe a currency that is decentralized and no central entity can control or affect, it's not subject to beliefs or political views, maybe energy use is worth it for that purpose. But you know, I'll leave that up for you to read about and decide. But I think regardless of what you believe on that, I think we can all agree that decreasing energy use and making energy use for mining Bitcoin more green is a good thing. And you're seeing this pop up all over the place. I've heard about waterfalls in Africa. I've heard of fjords in Norway and El Salvador, which is the first country to make Bitcoin their official legal tender, also wants to make it more environmentally friendly, and they have volcanoes, and so they're using energy to do that. Now, proof of work is what hashing in Bitcoin is called. And why is it proof of work? Well, it's because the way hashes are, you can actually prove, based on the underlying data, that you went through the process, you did the work to solve this, right? You can prove this is the input data. I have a hash that has 80 zeros, and you know I couldn't have done that any other way besides doing the work of hashing a nonce. Now, this A has two downsides. One, the energy use problem. By the way, did that answer the energy discussion? Yeah, and if you want to ask more at the end, I'm happy to talk more. One, it has energy implications, and two, Bitcoin blocks take about 10 minutes for mining, and there's a reason why behind that. Now, there have been other protocols that also use proof of work that decrease that time to, say, 5 minutes or 2.5 minutes. That's Litecoin. But for many purposes, that's not fast enough. So let's say you want to walk into the store and use Bitcoin to pay for a coffee. If you have to wait 10 plus minutes for the transaction to go through, it's not really effective. So those are just some of the considerations and trade-offs that people are thinking about. And of course, Bitcoin started this revolution of blockchain. And you know, these are just some of the protocols that are exploring those trade-offs and innovating in new ways to create new protocols. One of those is Stellar, which I'll tell you about at the end, and the other is Ethereum. So Ethereum is the second largest cryptocurrency by market cap, and this took the idea from Bitcoin and Satoshi Nakamoto of what if we could do what Bitcoin's doing, but actually add programmability on top of it. So we can essentially create a decentralized world computer where data can be shared and things can occur without control from a central entity. So this programmability took on the term smart contract. Who's heard of smart contract? Some of you may just be shy. I feel like more than are raising the hand have heard of smart contracts. But smart contracts is the term which says let's pull out the third party from a contract, but still make it executable in a trustless way where I don't need to know you or I don't need to trust that you will cheat me, that you won't cheat me. In fact, actually, Bitcoin transactions is a form of a smart contract, right? Because now I can send money from one entity to another without any trust in a third party. But Ethereum has taken it one step further and created this whole world of what's called DeFi, where now you can have lending, you can have borrowing, you can have trading, all on a blockchain without a third party. You don't need a centralized exchange. You don't need a bank. Now you can lend out your cryptocurrency and earn interest or yield on that without trusting a third party. And what does that mean? Well, your yield's probably going to be higher because now there's not a bank that needs to pay its employees and for research and software and all of the above. Of course, there still is a cost on Ethereum, and that comes in the form of gas fees. And as we talk about trade-offs, once again, like Ethereum is amazing because you can literally program anything on Ethereum and have it execute in a trustless fashion. But there's trade-offs with that, right? It's costly. You may have heard of Ethereum gas fees being very high. So it costs a lot to use Ethereum. And it's also prone to errors and bugs. So you're creating these smart contracts. There was recently a protocol called Compound, which was a lending platform built on top of Ethereum that had $80 million worth of Ethereum leaked out to, or $80 million worth of Compound token, or whatever it is, to people who didn't earn that money. And so that was all because of one greater than or equal sign in the code there. So with this awesome technology also comes great risks and other trade-offs like slower execution and higher costs. So while we're talking about trade-offs and why I'm, where I work, Stellar, Stellar has a very specific focus. So Stellar is a decentralized network that's built to create the world's financial infrastructure. We want to create financial institutions and make sending payments as easy as sending email, right? And so for us, it's not okay for a transaction to take 10 minutes. Once again, the payments use case, you go in for a cup of coffee or you want to transact, you need that to happen instantly. And so Stellar makes some very Stellar is very focused, the network's very focused on payments specifically, and because of that focus, it's able to have lower costs and faster transactions. And so what is Stellar used for? And I want to make it clear again, so I work for the Stellar Development Foundation, which supports the Stellar network. We're a nonprofit that was created when Stellar was created, and a certain amount of lumens, or our native currency, was allocated to the foundation to help the network grow, to help the Stellar network grow and advance the network. And hiring me is one of those use cases, and paying for engineers who can help build out the technology, and even coming into students and teaching them about the benefits of blockchain and Stellar is all part of our mission to grow the network and to get more people using the technology. Ultimately, we want to make we want to give equitable access to the financial system. So Stellar, what it's good for is really making digital representation of all forms of money. So have you heard the term stable coins? Yeah. So even though we have a native currency, Stellar Lumens, you can actually issue your own assets. You could issue an asset today on your own if you'd like, just a few simple lines of code or using a user interface that makes it easy. But where the real value lies is when you issue an asset that's backed by a real world asset. So our largest token on the Stellar network is USDC, or US dollar coin, which is a US dollar pegged cryptocurrency. And if you think about what that means, using Stellar, you can now send a US dollar anywhere in the world instantly, as long as somebody has a Stellar wallet. And in the news, you might have seen, we just had a partnership with MoneyGram, which is in every country in the world just about. And now they're able to convert between local fiat, local cash, and USDC. So that unlocks the power of digital money. Now you can send it anywhere in the world. If you think about in countries where there's high inflation, we have a product called Vibrant, which is for Argentinians who can deposit Argentinian pesos, physical cash Argentinian pesos, which have 50% inflation this year. So remember, that means $1 this year is worth 50 cents next year. they can actually deposit these pesos with a company that we partnered with and hold US dollar coin, USDC, in an app, and they're subjected to much lower inflation. You can also tokenize stocks, equities, and give access to more people all around the world who don't have access to the US financial markets. And how do we do all of this? Well, we partner with what we call anchors. And these are licensed financial institutions that serve two functions. They issue tokens, whether it be currency tokens, where they hold the reserves of that currency and issue the token on the network, or in the case I just mentioned, right? They hold a stock or a bond, and then they issue a digital representation of that. And then the other is the fiat on and off ramp. So I gave an example of MoneyGram. Well, MoneyGram enables you to go from fiat or your physical cash into digital currencies and back. And yeah, so we talked a little bit about stable coins. The one piece that I'm really excited about, and a lot of my work is, and I was actually just in Ukraine working with the innovators there on a digital currency, is central bank digital currencies. And so what does that mean? Instead of issuing a digital currency like USDC that's backed by the US dollar, you would actually have a country issuing a currency natively on Stellar. So there would be no backing, it would just be trusted in the faith of the government. And of course, on Stellar you can trade tokens. We have a built-in decentralized exchange, and we just announced an update for automated market makers, or AMMs, built into our protocol, which enable the exchange between currencies to happen instantly on our protocol. So, down the line, if there's more stable coins that are connected to the Stellar network, you'll easily be able to transfer between US dollars and Nigerian naira or Argentinian pesos instantly at a much lower cost than traditionally you have today with the correspondent banking system and all the intermediaries that there are. And yeah, just talked about this, how you can transform currency as you send it. So just quickly, how you can get involved. We're a public network, right? We have a Discord that anyone can join. You can build applications today on Stellar. You can start researching it. You can create your own asset. You can move lumens around. Stellar Quest is a great kind of session or training place to learn how to use the Stellar network, and you can earn real lumens prizes. And then we have a community fund which awards a certain amount of lumens to projects that have built on the network that we weren't involved with. I also have some additional resources. I'm not giving you this deck, so I'm happy if anyone emails me to provide more information on Stellar. And also, we are always hiring, so I don't know when you guys are graduating. I think you're all second years. I almost said sophomore, but I know you guys don't say that. I'd be happy to chat about a career in blockchain and crypto. And that's it. So questions. Thanks.